Hello and welcome to a discussion that provides an overview of pension. A pension is a retirement benefit paid to employees. Watching this video will help prepare you for class. It is important that you view this video before class so that we can learn more together in class. After viewing this video, you will be able to locate items related to pensions on the financial statements. You will be able to describe and account for a defined contribution plan. You will be able to describe the three major pieces of a defined benefit plan. Take a moment and look at the balance sheet of JCPenney and locate the line items related to amounts owed to employees at retirement. Amounts related to pensions can be either prepaid or a liability. The amounts reported as current are expected to be paid within the next year. Most of the amount is reported as non-current because it will be paid in the future after employees retire. The amounts for JCPenney are not significant enough to have their own line item, and amounts related to pension are included in the other assets or other liabilities. Gains and losses related to pensions are reported in other comprehensive income until they are reported on the income statement in future periods. It is common that the retirement liability is large enough that a separate liability is reported on the balance sheet. Take a look at the income statement for JCPenney and see if you can find the line item associated with pensions. Pension expense is generally an operating expense. Take a look at the cash flow statement of JCPenney and see if you can identify the line items associated with pensions. A company is required to make periodic contributions to the pension plan. The cash contribution is not generally equal to the expense for the period. The difference in the cash paid and the expense is reported as a non-cash item or a change in asset or liability in the operating section of the cash flow statement. There are two types of pension plans, a defined contribution plan and a defined benefit plan. We will discuss the defined contribution plan first. It is just like it sounds. The contribution that the company gives to the employees is defined. It generally is a percent of salary. For instance, TCU puts 11% of an employee's salary in an investment account of the employee. The payment is made with each paycheck. The company has an obligation to make a contribution periodically. The company does not have any liability to employees after they retire. The employee has the responsibility of investing the funds to grow to the amount needed at retirement. No liability is reported on the balance sheet because the company fulfills their obligation when the cash payment is made to the employee. The amount of cash paid is recorded as pension expense. Accounting for a defined contribution plan is very simple. There is only one entry. Pension expense is debited for the amount of cash paid. There is no liability for any future payments. In a defined benefit plan, the company defines the benefit the employees will receive upon retirement. This is generally a monthly check that is based on some percent of salary at retirement based on how many years the employee worked. An actuary computes the amount that the company must contribute now that will grow to an amount that will pay the monthly checks to employees after they retire. The company is obligated to make sure funds are available to pay employees after they retire. There are three major components to a defined benefit plan. The first is the pension trust fund. The company contributes funds to the pension trust fund, and the pension trust fund is an independent entity with its own board of directors and management team. It is not owned by the company. ERISA, which stands for the Employees Retirement Income Security Act, determines how much cash the company must contribute when to the pension trust fund during the years. The pension trust fund pays retirees. The pension benefit obligation is the present value of the total amount that is owed employees. This amount is computed by an actuary based on the terms of the plan, how long employees are expected to work, salary levels at retirements, how long employees are expected to live after they retire, and many other factors. The pension trust fund is not owned by the company and is not reported on the balance sheet. The pension benefit obligation is a liability of the company. The liability is netted with the amount held in the pension trust fund because the trust fund will be used to pay the liability. The net amount is reported on the balance sheet. Pension expense is a calculated amount that represents the cost of employees working one more year. This is a current period expense only. Pension expense is not equal to the amount of cash contributions determined by ERISA and made to the trust fund by the company. Pension expense is reported on the income statement. The company's obligation to employees is computed two different ways. The pension benefit obligation is computed assuming employees will have salary increases before they retire. It is more realistic to assume salary increases will occur, and the PBO is used to determine the net liability that is reported on the balance sheet. The accumulated benefit obligation is the obligation to employees at the current salary levels. It assumes there will be no future salary increases. The ABO is a minimum obligation that is only reported in the footnotes. Both obligations are computed at the present value, the amount the company would have now to grow at a certain interest rate to be enough to pay all the employees the monthly amounts promised by the plan. After viewing this video, you should be able to locate items related to pensions on the financial statements. You should be able to describe and account for a defined contribution plan. You should also be able to describe a defined benefit plan and state the three major pieces of a defined benefit plan. We will continue our discussion on defined benefit plans in the next video. Thank you for being prepared for class. It is much appreciated.